Hello and welcome to Economic Lifelines Nigeria. I'm Wale Famrewa. Our program examines the efforts of Nigerian authorities to vitalize the second largest economy in sub-Saharan Africa. From New York to London, Russia to Spain, Greece to Ireland, the world is littered with incredible tales of not just the loss of wealth, but of banking sector crises that have actually shaken the very foundation of several economies. Across the world, we've seen different methods crafted to safeguard financial systems and provide lifelines to struggling economies. On this program, we examine the efforts of Nigerian authorities to safeguard Nigeria's banking sector by creating the Asset Management Corporation of Nigeria, otherwise known as AMCON, an institution welcomed by many, but mired in controversy. But first, let's start by taking a look back at the background to the latest banking crisis in Nigeria, which many now say is behind us. In 2004, perceived vulnerabilities in Nigeria's banking system compelled the central bank to institute reforms designed to consolidate and strengthen the banks.
In 2004, the central bank announced a new policy of consolidating Nigerian banks. There were 89 banks in the country, most of them weak, small, boutique banks with average capital base of about $10 million. And then the central bank decided to consolidate these 89 banks into about 25 banks.
If you recall back in 2004, actually, when Soludo came out with that pronouncement that all banks must have a minimum capital of 25 billion naira. You had the average bank in Nigeria probably had a capital base of 2 billion. And so there was initial shock at the sort of the effrontery of such a CBN circular directive. And then after a while, people began to realize they were serious.
No consolidation of such a huge proportion had ever happened. It signaled what I think was the beginning of the modern era of banking in Nigeria. Because the whole point was to consolidate the banks, create economies of scale, make the bank's capital stronger, and allow them to be able to take on big ticket transactions and to just play a better and bigger, more effective role in the financial sector.
To meet the new capital requirements, the banks had 18 months to either merge or raise a lot of capital.
And UBA was the first one off the block to actually announce they're going to do something with the merger of UBA and Standard Trust Bank. And very quickly, other banks joined in the fold. The two bigger banks, the two other big banks, First Bank and Union Bank, were very little, just shy away of the 25 billion, so they made it up from their earnings for that year. GT Bank and Zenith, I recall, had luckily been raising money around the same time that circular came out. So by the time they finished their offer, they too met the standards. Now the rest of industry then went into this whole momentum of raising equity capital, initially through private placement, then listing by introduction and IPO. So some of them actually had a 2 or 3 stage public raise, equity raise, within that mid-2004 to end of 2005. Over that period, we saw a total of $15 billion raised just within that 18-month period. And you saw the industry shrink from 89 banks to 25 banks. But that raise didn't end there. Into 2006 and 2007, another $10 billion was raised by Nigerian banks, mostly from the equity markets, although there were a number of fixed income transactions. GT Bank accessed the Eurobond market, and so did First Bank.
Armed with fresh capital, Nigerian banks grew exponentially between 2004 and 2008.
The banking sector grew from $29 billion in 2004 to $103 billion by the end of 2008. This represented a compounded annual growth rate of about 50%. So you had a situation where the industry was growing significantly faster than the economy.
It was then common to see banks double and even triple profits as they leveraged expanded balance sheets to create a variety of speculative loans, and many even embarked on what some, with the benefit of hindsight, now call poorly conceived expansion across Africa and outside the continent.
Some of them had announced that they were going to become the top 10 biggest banks in the world. In fact, one Nigerian bank has started opening a full bank in China. I mean, how can you leave Nigeria to go and do banking in China when you can't take care of the local front?
The banks began a process of global expansion. Nigerian banks developed global intent, but they developed global intent without a clearly articulated national or local intent. And ultimately, all politics is local. As they say, you might say even all economics may be local because, as they say, banks can be global in life, but they're national in death.
Nigerian banks emerged as recognized brands on the African continent. But while the recapitalization of the banking sector was widely applauded as a good idea, it created fresh problems.
First, it created very rapid growth in the Nigerian banking industry. Credit growth grew by about 40% from what I understood at the time. And the growth was not necessarily the growth of credit into the real and productive sector of the economy. A lot of the growth occurred, it was simply an increase in the capacity of the banks to engage in speculative behavior. It led, with of course the banks having to foray into the capital market in search of funds, it created a huge boom in the capital market.
You had a situation where CEOs that were running small banks were very quickly running very big banks that they were not prepared for. So the banking industry outstripped the managerial capacity of the leadership team of the banks. They had very weak corporate governance standards. They had very weak risk management systems, very weak financial management systems. There were no business plans prepared by these banks for this capital being raised. Typically, when you want to raise capital, you have a plan of what to do with it. There were no plans. And the banks, the CEOs were basically building empires. And those empires were built on a very unsustainable foundation. You know, the foundation was so shallow that some of them, you know, because they were not prepared for, you know, what to do with this money, started expanding into all sectors of the economy. Insurance, stockbroking, real estate. You know, banks started financing things that they were not supposed to finance. So essentially, you know, you had a situation where, you know, in accounting is referred to as overtrading, but what I would say is they were overtrading on their managerial capacity, and that led to the crisis that we saw.
The weaknesses in the banking system that seemed adequately capitalized began to unravel in March 2008.
So the peak in the market in 2008, you know, prior to that point, everyone was relaxed. But the turn in the cycle exposed those very significant concentration risks that were lying just below the surface in the banking sector and were perhaps unacknowledged until that time. The sharp drop in the oil price was kind of a secondary development in terms of the demise of the sector. Again, the concentration issues meant that the downstream oil and gas sector had been a recipient of credit. You know, it was a good place to lend when refined product prices were continuing to be strong. But the drop from $147 to around $40 was over a matter of months. So again, the ability of such borrowers to repay in a context where, you know, a lot of credit had been extended meant that banks found themselves with significant rise in NPLs to the sector.
It was like, you know, what you could call a perfect storm. You had a drop in crude oil prices. You also had the big financial crisis globally. So fund managers that had come to take advantage of the opportunities in the market here were quickly retreating back. So they were withdrawing their capital at exactly the same time, you know, that crude oil prices had come under pressure. So these two points led to a sharp decline in the value of the naira. And as the naira was declining, fund managers were rushing out to take their positions out of the country. Number two, most of these loans were margin loans were financed by collateral, which was also equities. And as the market began to drop, well, you found a situation where, you know, investors or those guys that borrowed the money had to sell equities to repay the banks. And everybody rushed in to sell equities at the same time. So the market just stumbled and lost about 50%.
The combination of these events led to a major confidence crisis in Nigeria's financial system.
There was always some skepticism, broadly speaking. There was always a sense that, oh, well, this bank isn't in great shape or that bank isn't in great shape. You heard rumors, you heard stories. The extent of it was still a shock when it eventually came out. At the time, you knew that certain isolated institutions had difficulties. What you did not know was the sheer size of those difficulties.
I remember back in 2009 and early 2010, rates dropped as low as 3%. In some of the perceived banks, I mean, for instance, Guarantee Trust Bank there was giving, taking more than 2%. So it was like, what else are you going to do with the money? There was this whole email going around and, text messages about the bank that will collapse next and the next bank that will collapse. And it was beginning to affect the good banks. So you saw a situation where there would have been a massive run on all the banks.
Credit spread between the NIBOR curve and the sovereign curve ranged from 1,000 to 2,000 basis points, which is 10 to 20%, which is very large. Government security yields were single digit, but mostly the NIBOR curve ranged from the mid-teens, sometimes to the early 20s. Huge credit spreads. And the expanded discount window was opened, I believe, in late 2008, which was essentially a function of the collapse of the commercial paper market. A lot of the banks that were having liquidity challenges had were funding themselves via guaranteed commercial paper, which they issued onto the market. And as long as their credit was strong, other banks or investors were willing to take that risk. But sometime in 2008, there was a pulling back on the part of the market and people were no longer willing to accept the risk or the credit of those banks. And at that point, they turned to the central bank and the expanded discount window was opened.
Months after, Sanusi Lamido Sanusi was appointed as the new governor of the central bank. His first priority was to investigate the extent of a crisis that was not only scaring traders in the interbank market, but also regular depositors.
I hereby remove the managing director and all executive directors of Afrobank PLC.
A special audit of the banks was conducted and revealed massive realized and unrealized losses from loans to traders in the stock market and to players in the downstream oil sector coming to grips with a sharp decline in crude oil prices.
These 5 institutions are in a grave situation and that their managements have acted in a manner detrimental to the interests of their depositors and creditors.
Due to loan losses, banks were massively undercapitalized, and after the central bank took decisive steps to calm the panic, the attention of authorities turned to addressing the massive portfolio of bad loans in the banking sector, a problem that would not go away easily. Coming up.
So the question then became, beyond these immediate intervention steps, how do you establish and ensure financial stability for the period going forward that was visible within our line of sight, which is to say the next 5 years, the next 10 years, and so on. And I think the central bank decided that it had to do something much more fundamental, and that is it had to deal decisively and completely with the question of the bad loans.